Are we ready? All right. Welcome back again. My name is Larry James. I appreciate you investing in yourself. If you purchase my course, if you're doing this on YouTube or something like that, that just means that you got a chance to look at it before I put it in a course. Now, what my company teaches you how to do is set up the foundation of an online business while assisting you with becoming more comfortable speaking about it. But for March, April, and May of 2021, I'm creating a system to kind of give you a path to walk through for you to create your own online business, right? Based on what you like, what you love, or what you would like to learn about. Just like what I'm doing here. I didn't know too much about the stock market, but now by me sharing a whole lot of information about it, I'm able to learn more for myself. Plus, it allows me to create a product that I can put a price on and sell. Then that becomes a way that I can generate an income, which is what my company teaches you how to do at your own pace, in line with what you already like. You've heard the saying that if you are doing what you love, it's not really work, right? And by you identifying what it is that you love, then you can create a business around that. And, it can kind of replace that 9 to 5 or 8 to 4 that you're probably working right now. And maybe not. Maybe you just want to make, two or three hundred, $500, $600 extra a month, doing something. And then, over time, you might, decide to make that move to transition from your job to entrepreneur, right? Totally. Anyway, what I'm going to do is I'm going to title this video, The Basics of Trading a Stock. The Basics of Trading a Stock. Now, I've been doing research on a system, excuse me, called Investopedia. And this is a great process for me to gain knowledge because it's very thorough. People are on there are really good in describing and explaining. So I'm just simply explaining, excuse me, explaining what I've learned from them to you, right? Via copy and paste. This is exactly what you would do when you're creating your system, right? Exactly. So I'm not going to take too long because I've been going about 15 to 17 minutes per video for this final course. But I'm going to try to keep it around there. I don't want to go too much past 20. I like to keep it below 17 if I could. So we're going to start real quickly. Now, there's going to be a lot of information in this, excuse me, because this is phase 3 of the 3 phases that I'm creating for this system. And this one is more action-packed, more intense. So open your ears and, you can always go back to the show notes. I'm going to put those in the, you already know those are there if you purchase the course. But if you're thinking about purchasing the course before I launch it, then just know that that'll be there. Excuse me, I got a little something in my throat, so if I get a little stammered, don't worry about that. Okay, the basics of trading a stock. While the proliferation of digital technology and the internet, many investors are opting to buy and sell stock for themselves online instead of paying advisors large commissions to execute trades. However, before you can start buying and selling stocks, it's important to understand the different types of orders and when they are appropriate. So on this video, I'm going to cover the basic types of stock orders and how they complement your investing style. Okay, so we're going to initially start out talking about what's called market order versus what's called a limit order. Have you ever heard of those terms? Market order versus limit order. Let me explain a little bit about those to you. A market order is the most basic type of trade. It is an order to buy or sell immediately at the current price. Typically, if you're going to buy a stock, then you will pay a price at or near the posted ask, A-S-K. If you are going to sell a stock, you'll receive a price at or near the posted bid, B-I-D. One important thing to remember is that the last traded price is not necessarily the price which the market order will be executed. In fast moving and volatile markets, the price at which you actually execute or fill the trade can deviate from the last trade price. Okay, now the price will remain the same only when the bid and the ask price is exactly at the last traded price. Now, a little tip is that market orders do not guarantee a price, but they do guarantee the order's immediate execution. And market orders are popular among individual investors who want to buy or sell stocks without delay. The advantage of using market orders is that you are guaranteed to get the trade filled. In fact, it will be executed as soon as possible. Although the investor doesn't know the exact price at which the stock will be bought or sold at, market orders on stocks that trade over tens of thousands of shares per day will likely be executed close to the bid or ask prices. That is market orders. Now, I told you we're going to talk market orders versus limit orders. Excuse me. So limit orders. A limit order, sometimes referred to as a pending order, allows investors to buy and sell securities at a certain price in the future. This type of order is used to execute a trade if the price reaches the predefined level. The order will not be filled if the price does not reach this level. In effect, a limit order sets the maximum or minimum price at which you are willing to buy or sell. For example, if you wanted to buy a stock at $10, you could enter a limit order for this amount. This means that you would not pay 1 cent over $10 for that particular stock. However, it is still possible that you could buy it for less than the $10 per share specified in the order. Now, there are 4 types of limit orders, and I'm going to go over those with you right now. So get your listening ears on, because these are very important as well. The first type of limit order is called buy limit, B-U-Y, buy limit. It's an order to purchase a security at or below a specified price. Limit orders must be placed on the correct side of the market to ensure they will accomplish the task of improving the price. For a buy limit order, this means placing the order at or below the current market bid. Now that's for buy limit. Next, we have sell limit. A sell limit is an order to sell a security at or above a specified price. To ensure an improved price, the order must be placed at or above the current market ask, A-S-K. Got that? Next, we have a buy stop, B-U-Y, stop. And that's an order to buy a security at a price above the current market bid. A stop order to buy becomes active only after a specified price level has been reached, known as the stop level. A buy stop orders placed above the market and sell stop orders placed below the market, the opposite of buy and sell limit orders, respectively. Once a stop level has been reached, the order will be immediately converted into a market or limit order. And then the final segment on that is a sell stop. Now that's an order to sell a security at a price below the current market ask, A-S-K. Like the buy stop, a stop order to sell becomes active only after a specified price level has been reached. Okay, that's not too difficult, but a lot of this information you're gonna, kind of marinate, or it's gonna resonate with you over time, because that's how it's doing with me. Like some of these just automatically whoosh go over my head, but the more I continue to learn about it, it comes back up, it raises its head up again, and I say, I remember that. I remember hearing that. Okay, so with that, we're going to go into market and limit orders cost. The cost involved. Okay, now when deciding between a market or limit order, investors should be aware of the added cost. Typically, the commissions are cheaper for market orders than for limit orders. The difference in commission can be anywhere from a couple of dollars to more than $10. For example, a $10 commission on a market order can be boosted up to $15 when you place a limit restriction on it. When you place a limit order, make sure it's worthwhile. Let's say your broker charges $7 for a market order and $12 for a limit order. And stock XYZ is presently trading at $50 per share, and you want to buy it at $49.90. By placing a market order to buy 10 shares, you pay $500, and that's 10 shares at $50 each per share, plus $7 commission, which would be a total of $507. Got it? By placing a limit order, though, for 10 shares at that $49.90 price, you would pay $499 plus $12 commissions, which is a total of $511, which is only $4 more, but it's $4 more. You got it? Even though you save a little from buying the stock at a lower price, 10 shares at 10 cents equal $1, you will lose it in the added cost of the order, $5, which a difference of $4. Furthermore, in the case of the limit order, it is possible that the stock doesn't fall to $49.90 or less. Thus, if it continues to rise, you may lose the opportunity to buy at all. Okay? Now, additional stock order types, I'm going to explain a little bit about that to you. I told you this is going to be a little bit more intense, a little more action required, because you're going to have to think about some of these, and some of these you're going to have to go back over, because this is part of the learning curve that eliminates the people who know from people who don't know. So additional stock order types. Now that I've explained the two main orders, I'm going to give you a list of some added restrictions and special instructions that many different brokerages allow on their orders. Okay. The first one is a stop loss order. Stop loss order. And our stop loss order is also referred to as a stopped market, on stopped buy, or on stop sale. This is one of the most useful orders. This order is different because, unlike the limit and market orders, which are active as soon as they are entered, this order remains dormant until a certain price is passed, at which time it is activated as a market order. Got that? For instance, if a stop loss sale order were placed on XYZ shares at $45 per share, the order would be inactive until the price reached or dropped below $45. The order would then be transferred into a market order, and the shares would be sold at the best available price. Got that one? That was a little easier to digest, wasn't it? Now, you should consider using this type of order if you don't have time to watch the market continually, but need protection from a large downside move. A good time to use a stop order is before you leave on vacation, for example. Now, the next type is a stop limit order. These are similar to stop loss orders, but as their name states, there is a limit on the price at which they will execute. There are two prices specified in a stop limit order. The stop price, which will convert the order to a sale order, and the limit price. Instead of the order becoming a market order to sell, the sale order becomes a limit order that will only execute at the limit price or better. This can migrate a potential problem. No, this can mitigate a potential problem with stop loss orders, which can be triggered during a flash crash when prices plummet but subsequently recover. That makes sense, right? Good, good. I like that you know and that you're learning along with me. The next is called a all or none. AON is the acronym. AON. All or none. Now, this type of order is especially important for those who buy penny stocks. An all or none order ensures that you get either the entire quantity of stock you requested or none at all. And this is typically problematic when a stock is very illiquid or a limit is placed on the order. For example, if you put in an order to buy 2,000 shares of XYZ, but only 1,000 are being sold, and an all or none restriction means your order will not be filled until there are at least 2,000 shares available at your preferred price. Got it? Now, if you don't place an all or none restriction, your 2,000 share order would be partially filled for 1,000 shares. You see how that's working? That's all or none, AON. Next, I'm going to talk about immediate or cancel, IOC, immediate or cancel. And IOC order mandates that whatever amount of an order that can be executed in the market or at a limit in a very short time span, often just a few seconds or less, be filled and then the rest of the order canceled. If no shares are traded in that immediate interval, then the order is canceled completely. That's a immediate or cancel order. You see how this is kind of making more sense the more you kind of digest and process. Now, next we're going to talk about a fill or kill, FILL or kill, KILL, and that's FOK is the acronym. Now, this type of order combines an AON, which is all or nothing order, with an IOC, which is an immediate or cancel order specification. Now, in other words, it mandates that the entire order size be traded and in a very short time period, often a few seconds or less. If either condition is met, the order is canceled. No. If neither condition is met, the order is canceled. Let me read that back to you right quick. That's the fill or kill. This type of order combines an AON order with an IOC specification. In other words, it mandates that the entire order size be traded and in a very short time period, often a few seconds or less. And if neither condition is met, the order is canceled. My bad. All right, we're human, right? And this is what I want you to understand. You'll make mistakes. Just keep it moving. Get better at it. Then you get so good that the real mistakes don't matter. And mistakes really don't matter when you're doing this type of thing because it's a learning process and you get to a point, right? No perfection is required. Now I've got a few more I'm going to share with you before we shut out on this course. So the next one I'm going to talk about is good till cancel, GTC, good till cancel. This is a time restriction that you can place on different orders. A good till cancel order will remain active until you decide to cancel it. Now, brokerages will typically limit the maximum time you can keep an order open or active to 90 days. Now, a day, if let's say, if you don't specify a time frame of expiration through the GTC instructions, then the order will typically be set as a day order. This means that after the end of the trading day, the order will expire. If it isn't canceled, filled, then you will have to re-enter it to the following trading day. That's how that works. Now, I only have a couple more I'm going to talk about. The next one is take profit. A take profit order, sometimes called a profit target, is intended to close out the trade at a profit once it has reached a certain level. And execution of a take profit order closes the position. This type of order is always connected to an open position of a pending order. So basically, the bottom line is knowing the difference between a limit and a market order is fundamental to individual investing. There are times where one or the other will be more appropriate, and the order type is also influenced by your investment approach. A long-term investor is more likely to go with a market order because it's cheaper and the investment decision is based on fundamentals that will play out over months and years. So the current market price is less of an issue. And a trader, however, is looking to act on a short-term trend in the charts and therefore is much more conscientious or conscious of the market price paid, in which case a limit order to buy in with a stop loss order to sell is usually the bare minimum for setting up a trade. And by knowing what each order does and how each one might affect your trading, can identify which order suits your investment needs, saves you time, reduces your risk, and most importantly, saves you money, right? Wow, that's it. Wasn't that a lot of fun? I enjoyed that little system right there. See, what it's allowing me to do is allowing me to get better as well, because I have to work on things just like everybody else. I have other things I do too, but I must do these because I want to do this for this quarter and then show my other clients, how simple this is, and then, get people to participate in their own life, right? But what a lot of people are not doing, what you did, and that's investing in themselves. And you should always invest in yourself, continually finance your growth. It's important. It's essential because you don't know what I have to offer. And what I have to offer may change your whole direction. But just do your research before you do your investing. All right. So again, my name is Larry James. My company is Speak with Larry. And as always, share with someone else what I've shared with you.